This is TreppWire Week in Review for week ending June 18th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the Fed began to step away from the pandemic-driven monetary policy and moved up the timeline for interest rate hikes, saying these are signs of confidence in the economic recovery. Economic data was mixed this week. Retail sales dipped in May as consumers pivoted their spending dollars to restaurants and entertainment. Initial unemployment claims were a surprise miss, and prices that suppliers charge businesses rose again in May. Manus, Fed policymakers now expect to make 2 interest rate hikes by the end of 2023. And despite Fed Chair Powell's playing down the significance, the markets definitely took notice.
Well, it's a very interesting thing, isn't it, that for the last 2 months, we've been talking about inflation and the Fed perhaps being behind the curve. We see this language come out, which I don't think is dramatic, right? We're only talking about 50 basis points in all likelihood by the end of 2023. This is not the parting of the Red Sea when it comes to, surprises. Yet the markets react with additional volatility, right? There's a sell-off that comes out of this. But the immediate aftermath, all the quote unquote experts and talking heads say, well, we were kind of expecting this. Well, if you were expecting this, then there wouldn't have been a sell-off, right? And it was so measured as to be imperceptible in my mind, right? 50 basis points over the next 18 months. So something doesn't add up, right? People weren't really expecting this with Wednesday's announcement. Otherwise, there wouldn't have been this big dip in stocks, which kind of, spilled over a little bit into Thursday, and we saw some volatility on the 10-year. So I think it was the right move by the Fed to get in front of this. I think what we're going to see in the next, month or two is more indications of tapering. I think they have to get ahead of this after last week's CPI number, and I think it's a good start. It puts people on the track that their accommodative stance, while still being accommodative for at least the next year, is a little bit less so. And I think the markets had to hear that.
Yeah, thinking about is now there's 2 thinking abouts instead of 3. A couple months there'll be 1, and then eventually I'm waiting for them to drop the bomb of we're going to start reducing bond purchases, because that would be, that the last time they did that there was an issue, right, in the markets. So with the taper tantrum. So I'll be interested to see how that goes. I will give a personal anecdote real quick. I have some large expenses coming up soon. So yesterday I was just going through some of my stock stuff and just selling off kind of pieces of stuff. You know what I mean? Just kind of taking it down a notch. And I wasn't even really putting 2 and 2 together that the Fed announcement was coming out. I mean, I knew that, but I wasn't really thinking about it. And my last sale was at like 148, and the Fed announcement came out at 2, and everything kind of went down a percentage point or 2. So, every now and then you just get lucky by dumb luck, but I wish I could have that type of foresight, like consciously instead of subconsciously.
Sometimes it's better to be lucky than good, right? Isn't that the sports cliche, right? And
yes.
This week you were lucky, and it saved you a few bucks. So, it was an interesting week. We talked about the Fed stuff already. The retail sales miss, right, was the other side of the coin, which people were expecting modest growth in retail sales. Bank of America and Zero Hedge has been covering.
I was going to say, is anyone even looking at the retail number anymore? Or are they all just looking at the Bank of America number?
I mean, those guys, they've really run the table, right, for the last 5 or 6 months, really hitting this right on the head, calling for big surges when the market wasn't anticipating it, calling for misses when the market wasn't anticipating that. They did it again this month. So for those that don't get Bank of America's research directly, Zero Hedge does a really nice job of pointing it out and highlighting it. And if you're wondering where the next retail number is going to come from, Bank of America via Zero Hedge is a good place to look. But it is the other side of the coin, right? On the one side, we had PPI and CPI come in hotter than expected and so forth. And here we have the retail sales number disappointing, and some people chalking that up to all this stimulus having, quote unquote, pulled forward future sales, right? Which could mean that, for anywhere from home purchases to durable goods and everything in between, people have used that stimulus check and kind of burned their liquidity a little bit, which could mean that there's more disappointments on sales and activity in the future. It remains to be seen. But they are conflicting data points, one which supports maybe this transitory nature, right? The disappointing retail sales, and, the other saying maybe it isn't so transitory, right? The Fed saying, yeah, maybe we might want to hedge on this and get in front of this.
We did see lumber futures come down pretty nicely, which is, I think, a good thing for the overall housing market in the medium term. Yeah, and on the spending, I mean, everyone has their wave runner, their Ski-Doo, and their pool, and their new Trex deck, and all that other stuff. So now what? There was a data point or two in here that Martha had pointed out. So Yelp bookings, this is basically reservations at restaurants, essentially, right, are ahead of their pre-pandemic levels in almost every state in the U.S. except for New York. They reported 3.7 million diners in May, up 4% from May of 2019. So
I actually think that's 48%. I think it's that high from 2019. That's why that number is alarming. And so the question is, are there really that many more diners, or are more restaurant owners using online services to get people seated, to have contactless menus, to have them pay?
So we need Yelp to give us a same store sales analysis.
Exactly.
Come on, Yelp, get on it. Either way, I think it's positive, right? People are getting out. I love seeing those pictures of the beaches just like filled with college kids. The pictures that everybody was condemning a year ago, now everyone's happy about them.
Yeah, I think it'll be a little bit more nuanced, the recovery that we see over the rest of the summer. I think restaurants are going to do extraordinarily well, just based on my own anecdotal evidence. I think that they're bigger than they used to be because they've retained this outdoor seating, and now people are going back inside, and people really want to get out. And it seems like people are out. They're watching these NBA playoff games. They're participating in trivia. I think that will be really robust. I think, like you're saying, Joe, the beaches will continue to do well, which, bodes well for the kind of the staycation, the Jersey Shore, Cape Cod, things like that. On the other side of it, people have been expecting this extraordinarily robust recovery for places like Las Vegas and Orlando and so forth. And I think Las Vegas has seen extraordinary rebounding thus far. But you have to understand that we're now almost halfway through the summer, right? That kids start going back to school for colleges, August 1st, August 15th. In the South, they go back to junior high school and elementary school and high school by middle of August. So to the extent that, people haven't done it yet, that might disappoint, right? These family vacations to faraway destinations may be the kind of thing that is still a year away, right? But I do think that, that travel to places that you can get to easily late in the summer, I think that will still do very well, as it's done relatively well thus far in the last year.
I know I've been teasing it for several weeks, but next week you guys are going to hear the Odysseus-like journey that I take with my family on a plane down south. I'll give you on the ground recon on what's going on in the airports and how heavily they are administering the mask rule on my 2.5-year-old son, who's going to be smacking you in the face if you ask him to wear a mask.
Something tells me that you may not have to wait till next week's podcast for this. Like I could picture Joe.
You may see it on World Star Hip Hop or TMZ or something.
I'm just thinking, like on YouTube, maybe, Joe with those, what do they call those things that they put around your wrists, like the hand ties,
zip ties.
You're being frog walked off the plane while your kids are screaming, "Where's Daddy going?"
We're loading up on fruit snacks and Elmo and Curious George and Toy Story on the Kindle. So we're never like those parents that just hand them an iPad and give them headphones, but on the plane, that's what we're doing.
So CREFC held its annual meeting virtually again over the last 2 days. And we always think this event's valuable, not just for the sessions, but to be able to hear what people are talking about in the industry. What were some of the conversations you guys heard that you felt were worth sharing?
I think there was a lot of optimism in general. I think people felt great that the carnage that we felt over the last year wasn't worse. A lot of these people had lived through the great financial crisis where the carnage on the derivative side, on the bond loss side, on the mark-to-market side, and everything in between was catastrophic, right? It cost people, in some cases, their assets on the commercial real estate side. It cost some people their jobs because their banks went out of business. There was an awful lot of pain. And I think the fact that we've come out of this as well as we did had people feeling good. I think that there was an awful lot of attaboys and attagirls going around, that the market came together to come up with new standards so that there was transparency. There was creativity in terms of turning off the REMIC rules or suspending them for a while, using FF and E reserves for purposes of, the soft forbearances. I think the market really reacted very well, very professionally. And I think there was a lot of good to be felt about it. I feel like the biggest unknown at this point remains office. I think that I've heard this more than once where people were saying, anybody that can tell you how we're going to come out of this office situation, whether it's going to be good or bad, is really just putting their finger up in the air at this point. And I think that that's true.
So anything we say from now on about office, just know that on the video, I have my finger up in the air.
There you go. I think it was a feel-good conference, and I think that rightly so.
Yeah, a couple of other notes just from the field. A lot of positivity about the CRE CLO market and how that's going to be, a banner issuance year this year, probably the highest issuance ever. I saw a note or two about, some of the positives of the CLO structure and maybe, bringing those over into the conduit space. I'm not sure how doable that actually is. A few kind of notes about how many forbearances and deferrals there were and how many of them have come out and are doing okay. So really very, very positive. Cap rate, a couple of notes here, cap rate compression is not slowing down. A little bit eerie when you hear such unanimous positivity. That's always when you get a little worried, but listen, here we are. We got the Fed backstop. We got trillions of dollars in government spending. We've got people dying to get out and spend money. So
and we do have a lot of liquidity. Let's face it. There's a lot of money out there to be put to work. I think that's one of the reasons that distress has not been worse than it could have been. And that was something that was brought up by some people in the cocktail hours and so forth. I would say that in 2007, when, right before we drove the Cadillac into the brick wall, there was a lot of people saying, this is kind of crazy. Where does this end, right? Pro forma lending. There was people out there like Tad Phillip that, of Moody's that was just kind of ringing the bell, like this is getting a little nuts. And I think there were people at Trepp feeling the same way, that valuations, lack of skin in the game, synthetic CDOs, all those things were canaries in the coal mine. And I think that right now, there's nobody saying that, but I think in a good way, because there are no real canaries in the coal mine right now, right? We're not talking about excess leverage. We're not talking about pro forma lending again. We're coming out of this kind of on pretty firm footing, and that's a good thing.
It's funny you mentioned Tad Phillip. I think my father-in-law got paired up with him at a public golf course in Connecticut like a few months ago. And they got to talking, and the guy said that he worked at Moody's, and my father-in-law said, do you know Trepp? And he's like, of course I know Trepp. He didn't know me, but of course he knew you, Manus. You're famous.
Well, I'm not famous, but I've been around a long time, which is two different things. And, I always had a lot of respect for Tad because, he was a guy that, the rating agency business is predicated on, volume. If volume stays high, they get paid. And And as long as the conveyor belt keeps going, that's a good thing. And here was a guy with the integrity to say, somebody's got to say the right thing to do here is walk away. And it probably didn't serve the business well, but it probably served them very well reputationally, and it kept them from having bigger problems throughout 2008 to 2010. So, you got to have respect for guys like that can call out when they think the emperor has no clothes, as the market did in 2007.
What I'm going to be interested in, just kind of going back to office for a second, is, and I haven't done this yet, but maybe I should, looking at new originations in office and checking out the types of rollover reserves that lenders are requiring at this point. And I did see that in some of the CREFC sessions, there was talk about how reserves and how much reserves are required are kind of decreasing because the market's kind of coming out of this tough time. But that might tell you how the lenders are viewing the rollover risk. And I would assume anyway that it had. I mean, if you're looking at this rationally, you have to think that the rollover risk is significantly higher than it was pre-COVID.
Yeah, I mean, and it's one thing that'll be interesting, and it is kind of one of these things that can bite you, on the leg unexpectedly in the CMBS
Upper
market.
Not
leg?
expecting the leg.
The upper back leg area.
This is a G-rated show, man, and I stand by that. But one of the things that has bit investors in the past has been lease terminations. And what you see sometimes is there's a lease to a pharmaceutical company or a bank or something like that, and it's of size, and it runs to 2028 or 2029, but there's an out in 2023 that is exercised, or or 2021 or something. And all of a sudden that 10-year lease becomes a 3-year lease, and there's a lot of space that has to be filled. And while this stuff is disclosed in the prospectuses, it's not disclosed in a way that's easy to find. And we spend a lot of time looking for these things, and they're not all that prevalent, but they can become nasty stories when they happen. What I'm looking for coming out of that is there a lot more of 10-year leases with a 4-year out, because the guy who made this lease in 2021 said, I don't know what the future looks like, but I want it out in 2025. So I'm not taking on a lot of things. And one of the things we'll be looking for over the next year is evidence of this. And we actually saw some of it recently for a 2019 loan where, we wrote about it in TreppWire this week. I can't recall the story off the top of my head, but somebody got out of it, not long after securitization. They said, we're gonna exercise this thing, and we're gonna leave, a 30 or 40% hole there with not a big termination fee. We may see more of that in stuff that gets securitized this year and next year.
Yeah, and there's an element to this where some people might say, well, CMBS is a little looser than, bank underwriting or insurance company underwriting. But I would say at the same time, most office leases are not more than 10 years, right? I mean, I think most of them are 5, 7 to 10 years. Most CMBS loans are 10 years. So you're going to have some significant turnover, or at least expiration, either during the life of the loan or right around maturity, just because of that match of terms of lease and terms of loan. So, that's always a big thing. I don't want to be redundant, but I'll give Don Sheets a shout out because, like I said, I was taking his kind of elective class on distressed debt investing, and it's been absolutely great, I have to say. And I'm not just shilling, I really mean it. And one of the cases we looked at was exactly this. It was a 10-year loan, 7 years seasoning, 3 years left, with a huge tenant expiring like 3 months after maturity, right? So it's just all binary risk, right? If they re-sign, your money good. If they don't, you have some issues. So I don't think it's necessarily like a bad underwriting thing. I just think it's the nature of lease terms.
There's more of this than you would think out there, where the dominant tenant, or perhaps the only tenant, has a lease that expires within a year, longer or shorter, of the loan maturity.
Yep.
It's at some point we'll talk about anticipated repayment date loans. We're going to run too long today to get into that, and we'll talk about that maybe in an educational segment down the road. But this, this binary nature of this, and I like that word, is there.
We just completed our mid-year analysis, which is included in the magazine that we publish with our sister company, CRE Direct News, and it is aptly called the mid-year. Makes a lot of sense. We're going to walk through some of that analysis and sprinkle in some updates from TreppWire, and we'll go property by property sector, including some data, the good news, the bad news, and maybe what should we be watching for because it's an unknown trapdoor.
Yeah, it's interesting. We've been doing these magazines for 5 years, twice a year.
7 years.
7 years.
2014 TreppWire Analysis and Perspectives, the very first one.
There we go.
I remember it fondly.
Normally it would be available at newsstands everywhere, at airports and, commuter rail trains and stuff like that.
Seat drop on every Delta flight into Miami in June.
because we have COVID, you're not going to find it at your local newsstand this year. But actually, we do have this, and for people that are on our distribution list of our free blog material, you'll see some of these stories come through over the next week or two. And if you're not on our list, you can get on that free of charge by reaching out to Haley, and we'll get you on there. Our CREFC producer, Haley Keene, who does great work for us. But normally, over the last 7 years, we had segments called The Good, the Bad, and the Ugly, which were backward looking. And it talked about the good things, the bad things, and the really ugly things that happened either in the CRE markets or life in general. This season, or this publication, we replaced it with The Good, the Bad of the last year, and the unknown, which is kind of what we don't really know is going to happen in the market going forward. And we'll run through these property type by property type.
So let's start with multifamily.
So what did the data show us? Going into 2020, the delinquency rate was 1.5%. The disproportionate amount of troubled loans came from the student loan subsegment going into or pre-COVID. Delinquencies did tick up in 2020, but the uptick was really modest compared to things like hotels and retail. Delinquencies peaked at a little over 3% during the summer of 2020. By the spring of 2021, it was back to around 2%, and the percentage of loans with the special servicer never went above 3%. So what was the good? The good was that lending never really slowed down for apartment loans, with demand high for safe and relatively high yield fixed income returns, relative to treasuries and other things. Credit remained available and was plentiful. Sales volume was strong throughout the pandemic. Valuations remained really high, especially in the low treasury rate environment. The bad, as we've talked about on this podcast and in TreppWire, some markets saw some occupancy fall off, particularly things like Long Island City and Queens, other parts of Manhattan and San Francisco. The unknown, we pointed out, is with the eviction moratoria rolling off and stimulus checks ending, how will demand change in the second half of 2021? I remain pretty bullish on the market. I think that if anything, it comes back over the second half of the year as people go back to the offices.
Yeah, a big part of the multifamily obviously is Fannie and Freddie. They just, keep the gas pedal to the floor and continue to lend. And somehow we just haven't seen any sort of distress in that market really, of any sort of note, even with eviction moratorium and everything else.
I'll give you one more good out of that segment. We expected, the student housing segment to get crushed. People not going back to school, learning remotely and so forth, and it didn't. It held up extraordinarily well, and a really positive story for one that we thought might be a disaster last year.
Just means a lot of parents got gypped out of a lot of money.
I think parents just sent their kids to school. You're going.
It's one of the, the costs of doing business as a parent. As I guess your kids now, Joe, are 2 and 1. Is that right? Or 3 and 1?
Essentially, yeah.
Yeah. So you got a long time before you underwrite this college nut. But when it comes, you kind of understand that you set all logical thinking aside.
At the current rate, it's going to be like $1 million a year. If you just extrapolate it out the last 10 years and just continued for another 18. So hopefully something happens there.
Well, somebody with your, coming from your gene pool, I expect, there's going to be no shortage of suitors, for your kids,
Right.
intellect. Yeah.
So shifting to office, we were talking just a bit about how that is an area that is still uncertain in many ways.
Yeah. It's the most uncertain market. The data doesn't tell a story, right? Delinquencies were 2% going into the pandemic, modest increases, but it never got over 3%. And by the spring of 2021, it was back to pre-pandemic levels. Special servicing numbers never got above 3% either, just like with multifamily. What was the good? The good was that early on in the pandemic, the narrative was we're going to see a lot of credit problems, right? Tenants defaulting on their leases in the oil segment, the kind of borrowers that would tap into the CLO market, not the CRE CLO market, but those double B, single B, and triple C credits in the CLO market that are also tenants in offices. People thought this could be messy as we see big bankruptcy Chapter 11 filings of oil and gas and other industrial players. That never materialized, and it doesn't seem like it ever will. That was a good part of the story. The bad, a lot of sublet space, but even that is starting to at least peak, if not come back. And I think the unknowns we've talked about already, which are, when do people come back and to what degree? That's the good, the bad, and the unknown in office. And I think, Joe, you got some specific stories from this week.
Yeah, so we had some, specific office stories. One was on the good side. CAA, which is a talent agency out in Los Angeles, signed a large lease, 290,000 square feet at Century Park Plaza. That's according to Commercial Observer. And then on the TreppWire side, on the bad, if I want to steal some of Manus's lines here, the crabgrass. Speaking of grass, you guys got to watch the U.S. Open out at Torrey Pines. The balls just disappear in the rough. Anyway, sole tenant behind a 2017 loan to vacate. So the 13.1 million Verizon building was put on the servicer watch list this month after the sole tenant, which is Verizon, is exercising their termination option. So this is exactly like the thing we were just talking about. So the Verizon lease was originally slated to run until 2026, but now they've exercised an option and their lease will end in December. This is, like I said, a $13.1 million loan. It's in Wilmington, North Carolina. The property was valued at $25 million in late 2016. It's amortized almost down by $1 million since origination. It's about 2% of a 2017 deal, and it matures in 2027. So, these are the types of stories that you got to kind of be in the weeds, get it, to find these stories.
The big crabgrass one was 850 3rd Avenue. In Manhattan, which went to special servicing. That's a big loan, 177 million. They lost Discovery Communications as a tenant last year. There was a dispute over how much rent Discovery owed. We talked about that last year, but now that loan goes to special servicing with, now a 63% occupancy level, right? Down from the 90s last year.
That's a single asset deal. And single asset deals very rarely have any sort of distress, at least historically.
That's right.
There are a couple other data points here on office. So, we've been quoting this company Castle Systems a lot, and they've been coming out with a lot of good information. Good on them, right? They had something out that said fewer than 3 out of 10 white collar employees were working at the office on average in 10 major U.S. cities, including New York, LA, San Fran, DC. I'll be interested to see what this number is in September. I think it's going to be, 5 in 10 or 6 in 10, at least like 5-day work week. I don't think it's going to be 10 out of 10. And then obviously, you guys saw New York and California lifted their mandates this week, capacity mandates and all those types of things. So, free at last. It's going to be a lot of fun this summer, I think, in all the big cities.
We had a must know in that category.
Yes, last week we started with a new segment, which we may not do every week, But if we do have something that we consider must know, we'll throw it out there. So must know is something that, right, if you're in a particular segment and you don't know this or a particular geography, you probably should, because it's big enough that if your boss comes to you and says, what's happening with so-and-so's lease, you don't want to be giving them the humana. So this week's must know, Dun & Bradstreet, they're moving from Short Hills, New Jersey, down to Jacksonville. They're looking to spend $67 million to bring 500 jobs down there. This particular article, and I don't remember who wrote it. I wish I had written this down, but this particular author said Town Center 2 is the perfect structure in South Jacksonville. That particular building is near the St. John's Town Center property, would be the perfect building for Dun & Bradstreet to take over. So if you're a property owner, if you're a broker down there, if you're a leasing broker, and either you didn't hear about this story or you're not responsible for leasing the Town Center 2 office, you want to get on this right now, right? You want to get out there and make sure that you're at least in the running for this this big parcel out there.
Turning to industrial, which was a favorite during the pandemic.
Not much to say here other than keep on keeping on, right? I mean, the delinquency rate before the pandemic was under 1.5%. It blipped up slightly, but just barely. It's back down to around that level now. The percentage of loans with the special servicer never got above 1.3%, and it's under 1% most recently. That's kind of the data. The good, obviously, the demand for these types of assets just continues to be amazingly strong, especially from the likes of Amazon. The bad, nothing other than, how fast can we get these things built and leased up? And the unknown, I think, is basically at some point, the supply and demand equilibrium will be reached. It's just a question of when. So if that's a year from now or 6 years from now, I will say one thing, which is this may be a Lonnie point that he had mentioned on one of our calls at some point, but that this entire industry is completely reliant on Amazon demand. And not that Amazon's going anywhere anytime soon, but at some point businesses do change or get regulated more by the government, or if there's an antitrust situation or whatever. So like there's a little bit of that concentration risk in this market, which is really good right now because Amazon is just an absolute juggernaut. But it is something just to kind of think about for the future that, the list of the top 30 companies in the Dow Jones or the S&P from 30 years ago, there's only like one or two of those companies left today. So 20 or 30 years from now, you got to fill out this industrial space maybe with somebody else.
For what it's worth, I still use my Kodak, Instamatic camera where you got to drop off the film at the place and come back, 4 days later with your, duplicates.
Hotels, one of the sectors that was hit hard early on.
Yeah, I mean, we've talked about this issue quite a bit, so I'll really race through it. Pre-pandemic, under 2% delinquent, got as high as almost 25%. That number might have been 5 or 10 percentage points higher had special servicers not given borrowers the ability to tab FF&E reserves. The percentage of loans with a special servicer was over 26% at one point. At its peak, 70% of loans, hotel loans, were either with the special servicer or on watch list. The good is that delinquencies have declined really, really sharply, and we expect them to continue to decline throughout the second half of 2021. Fewer hotel owners throwing in the towel. And as we said earlier at the top of the podcast, kudos to everybody who worked on kind of coming up with creative ways to come up with relief. The delinquency rate, I think, could really collapse in H2 2021. The bad, still some soft markets, New York, Houston, Chicago, Portland. I feel like a broken record on that part of it.
Yeah, there's a Bloomberg headline this week. New NYC hotels are ready to party as guests slowly start to return I liked one of the lines in there. I don't have it pasted here, but it was something like, yeah, we used to have people jumping in the pool naked at 2 a.m. and like, I feel like we're going to get back there soon. So I guess that's a good, indicator of return to normal. We did have one story this week specific to CMBS. The Gansevoort Park Avenue Hotel is back with the special servicer. It's a $124.2 million hotel loan in Manhattan, 249 key full service hotel in Midtown South. It's been delinquent a few times early in the pandemic. It got some relief. It was able to tap reserves. It was struggling even before the pandemic. So it had DSCRs in 2019 below 1. Even when the occupancy was fairly high at 89%. So interesting story. There's a couple of pieces of that loan in 2 2012 deals, one of which is in CMBX 6, which we talk about a lot. So it was appraised at $258 million back in 2012, which was a 50 LTV. So even if it did have a reappraisal lower, there's a lot of room to move there. Just wanted to keep your eye on there.
So, in the last week or so, we finally had 2 million air travelers for the first time since before the pandemic. And we have not seen that in a long, long time. So that is a sign that there is traveling. And we had an analyst on our team who did some work looking at airport hotels and the impact that people going back to the airlines has to the hotel industry.
Yeah, so Jody, who's a great person at Trepp, she put together a quick piece here. Yeah, the last time we had more than 2 million travelers pre-COVID was March 7th. So it's been a long time. And just a couple, I don't want to go through the whole thing. You guys can find it on our website, but a couple of key points here is that if we just look at airport hotels, or it's basically hotels kind of near airports, and looking at the change in financial statement items from 2019 to 2020, revenue per key down 50%, operating expenses per key, because they are relatively variable, down 41%, NOI per key down 68, and CapEx down 50. So those are huge decreases. I will just point out a couple of markets here. These are relatively broad because we're at the state level, but we have the ability to dive in further in our data. This is just kind of a teaser. But in California and New York, I'll just rattle these off, right? So we're doing the classic California, New York versus Florida and Texas. Here we go. 2019 revenues per key, $80,000 in California in 2019, $30,000 in 2020. In New York, it was 49 in 2019 and 23 in 2020. So around a 50% drop in New York, a greater than 50% drop in California. In Florida, went from 40 to 29, so less than 50% drop. In Texas, it went from 30 to 25, so kind of 1/6 there, right? So, just giving you guys a little taste of that. It's really interesting and important information, and we have kind of a really interesting way of looking at it and slicing and dicing it. So if you're interested in that, hit us up at podcast@trepp.com.
Let's go right to retail then.
So retail, the story is not that unlike hotels. Heading into the pandemic, it was the worst performer with delinquency rates between 3% and 4%. That was largely due to a high percentage of B and C mall loans that were already in default heading into the pandemic. Delinquencies got up to about 18%. It wasn't as high as where hotels were. Hotels were hit across the board, which was the reason for its extraordinarily high delinquency rate. In the retail space, there were plenty of pockets of resilience, grocery anchored, Walmart, Target, Home Depot anchored, things like that, were really, terrific performers throughout 2020 and 2021. Even properties that hosted non-essential tenants like Burlington Coles, Hobby Lobby, Ross Dress for Less, Michaels, et cetera, surprisingly resilient. It was really just the B and C malls, and sometimes the A malls would become delinquent, that really dominated the bad. over the last year, and that still is the case. And unlike hotels, where we expect a really robust recovery, we don't expect a robust recovery in the B and C mall space. We think that more will muddle through than perhaps we thought 6 to 9 months ago, but there'll still be lots of defaults, lots of losses. And just this week, Washington Prime Group went Chapter 11. We thought this was a possibility as far back as March when they missed an interest payment. They filed for Chapter 11 on Sunday night, and they have several CMBS mall loans out there. So that story remains to be written.
Yeah, so along the lines of some of the payoff report stuff we talked about last week, there was another CMBX 6 mall that failed to pay off at maturity. We talked about it this week. It had been, this is the Visalia Mall, $74 million loan. It had already been extended by 1 year last year when we wrote about it. It was supposed to mature June 2020, then it got pushed out to June 2021. This month, the loan missed its maturity date. Some of the servicer notes suggest that they may have granted the borrower some more time. So this may not be a terrible turn here. It may just be a little bit of, they need a couple extra months to get a refi done. Although a similar comment was made in July of 2020. So this is a 6.39% of a UBS 2012 deal, which is part of CMBX 6. The value of that collateral or that loan actually, which we noted last September, was dropped from 115 million to 86 million. So it's a 440,000 square foot mall in Visalia, California. It did have a very strong cash flow coverage of 3.25x in 2020. So I assume I'd have to look a little deeper. Maybe there's some tenant expirations or some other issues there in terms of, or just kind of capital markets issues in terms of getting a refi done.
So why does this matter? You know, it's a term I use a lot. You know, we wondered how aggressive special servicers would be in pushing for foreclosures and how quickly these CMBX 6 loans would resolve, right? Early on, it was thought that the defaults and losses would be accelerated. We had some of our listeners kind of push back on that narrative over the last couple months and say, you know, this is taking much longer than people thought it would. And this is another example, to Joe's point, of that being true, right? Here, the special servicer was kind of out without batting an eye, said, you know, we're going to give you more time, right, to figure this out. And that is detrimental to the shorts who want to see losses, to the extent there are losses, happen quickly. And it is beneficial to the CMBX 6 longs who can continue collecting premiums as these things stay out longer.
So we had one in that category that was under the unknown.
Yeah, this is actually not as much unknown as it is oddball, in that we did find out what happened here. It was unknown for a while, but we had a enterprising Trepp sleuth put a couple things together. So the mall at hand is the $58 million Newgate Mall. Ogden, Utah is where the property is, deeply distressed. The property was valued at 83 million at securitization, dropped to 20 million. So this is a not a happy story to begin with, but there was a happy part of it this week when there was a downgrade recently, with the downgrade pointing towards a movie theater closing in the mall that represented more than 12% of the space, of the collateral space behind the loan. So our sleuth, and I'm not sure why this happened, but they went out and went on to Fandango and tried to buy tickets for a June showing of this mall that was supposed to have been closed. And they found out that they could. And the person said, well, maybe this movie theater isn't closed after all. So they called the guy at the front desk and said, is the movie still open and is it closing? And the person said, yes. And then he went the extra yard to call up the receiver and say, I just want to confirm that the theater is still open and not closing. And that too is true. So this is just a small beacon of hope in an otherwise miserable story for the Newgate Mall which is also part of CMBX 6. So we always like ambitious employees, and we got to do something for this guy. I don't know, maybe something more than a t-shirt, like maybe a nice bottle of wine or something.
Maybe some movie tickets.
Oh,
That would be
there
funny.
we go.
At that theater.
Ogden, Utah. We're gonna have to stick him on a plane, and we can't even give him wine. That might be a dry town. I don't know.
Definitely no. All right, shout outs of the week. Let me run through those. Sam M. He likes the podcast, everything we do. Keep up the great work. Dudley B on Twitter, despite your best efforts. If you listened last week, we did an entire segment on Cecil, and we all commented that we were the only ones listening, but apparently Dudley B listened.
Only the strong survive.
Yeah,
you have to be intrepid
definitely.
to make it through that. So good on you,
Definitely
Dudley.
was, and he's not the only one, because Vipul M, he said, I was the one listener that stayed on. So at least there were two of them listening, and he loved the conversation around Cecil.
It's now being repurposed as an interrogation device, right? That last 15 minutes of the podcast being used to,
On a loop.
That's right.
It was somnolescent. Is that the word?
I don't know.
Is that the right way of saying it?
Psychological warfare.
And, somehow we got Mike B's mom, who enjoyed the last episode and had a great suggestion for a cheat sheet for all our banking abbreviations. So I thought that was interesting. And we've already mentioned Don Sheets, who is both a guest and a listener and an instructor and whatever else.
The Renaissance man.
Yeah, exactly. So, gentlemen, this weekend is Father's Day. Some people might be wondering what to get. Well, I have an idea. The Girl Scouts have about 15 million boxes of unsold cookies. So if you let me know what your favorite type of Girl Scout cookie is, I'll send some contactless delivery to both of you guys.
I used to love doing this. It was a little bit of an expensive practical joke that I would do on new employees, but they would come in and say, would you buy a box of Girl Scout cookies or two? And I wouldn't just buy one or two, I'd buy like 9. And they would be incredibly grateful at the time until they realized about 2 months later that they had to haul this stuff in on the train,
on the subway, on the bus.
And if it was somebody I hate to say this because they might be listening and they might know, but if they got under my skin during that year, I might even go for 15 boxes. Because you could always get rid of them in the building, give them to the doorman and the people that clean the building and stuff, and they were always grateful. You didn't have to carry it home yourself. But seeing this guy or gal come in with,
I think I know who that is actually. Under
their arms was just
that's pretty funny.
So gratifying.
So this weekend I stopped at a gas station on the way home from somewhere, and I just had to get a snack, and there were a couple of girls with their moms outside set up at the table selling Girl Scout cookies. And I'm watching all these people. I'm like, if you're the type of person who can walk by this table and not buy at least one box, like, come on, man.
Callous.
I got some Thin Mints. I got some Trefoils, if that's how you call it.
Samoas?
No, I'm not a Samoa guy.
I like the Samoas.
Samoa what? You're killing me, Smalls.
Oh my goodness. With that, we'll close. Thank you to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question, you know the drill. Send an email to podcast@trepp.com. For more information, visit trepp.com and subscribe to the podcast with your favorite provider. Happy Father's Day, guys. Thank you for listening and stay well.
All right.